Welcome back. In our top business story, Investment Corporation of Dubai, the Emirates Sovereign Wealth Fund, said today it will repay in full a $4 billion loan maturing on August 21st. It will finance the loan mainly with dividends from its investments, Reuters reported. ICD, which holds stakes in Emirates Airline, Emirates MED and developer Ema Properties, had been expected to repay part of the loan and had already agreed with banks to refinance $2.8 billion of the upcoming maturity. Today's announcement demonstrates that as part of the government of Dubai, ICD is committed and able to meet its debt obligations, Mohammed Al-Shaibani, Executive Director and Chief Executive of ICD, said in a statement. Abu Dhabi Islamic Bank reported a 5% increase in second quarter net profit today to reach a new record of 370 million dirhams. According to a statement on the ADX, the performance from the main banking business was strong as the bank's net revenues grew an annual 17% to 876 million dirhams. In addition, ADIB saw its customer numbers increase by nearly 14% since the second quarter of last year to more than 439,000. And also Dubai-listed Ahman Bank posted its results. Net profit in the second quarter is up 69% to reach 500,000 dirhams. Investors from Kuwait are the largest GCC buyers group of Dubai property. They account for nearly 60% of all properties purchased by GCC nationals in the Emirate, according to figures from the UAE Ministry of Finance. Dubai has always been popular with Kuwaiti investors, but given the price and the quality of properties now available on the market, Dubai offers even better value for money, Niall McLaughlin, Senior Vice President of Damak Properties, said in a press statement. First of all, property has become more affordable, and the revival of Dubai's property market is also underpinned by a more favorable regulatory environment. For instance, Dubai's new strata law, which favors homeowners, it has also contributed to renewed buyer confidence in the property sector, McLaughlin said. The GCC stock markets ended on the lower note again today as they are still suffering from risk aversion following S&P's US downgrade. The only market to buck the trend is Abu Dhabi's. In our world business news, most of the European and Asian stock markets posted losses today as they reacted to S&P's downgrade of the US credit rating. The fact that the safest economy isn't so safe anymore raised fears the downgrade could trigger a financial crisis like the bankruptcy of Lehman Brothers did in September 2008. The Nikkei fell 2.2%, South Korea's Kospi index even 3.8%, and Australia's benchmark even reached a two-year low by dropping 2.9% today, despite a conference call early on Monday morning Asian time between the G7 leaders who announced plans to take whatever action was needed to stabilize markets. And also crude oil fell sharply. WTI dropped to an 8-month low to below $84 a barrel. That's a minus of 3.5% today. Brent dropped to $106. On the flip side, the uncertainty haunting investors is letting the gold price soar to new record highs of above $1,700 an ounce as investors scramble out of riskier assets. That also sent the Swiss franc to an all-time high against the dollar. We earlier asked Gaurav Kashyap, head of DGCX trading at Al Pari Middle East DMCC, what we can look forward to this week, whether we will see the situation normalizing among all asset classes.
Not only did the market open at a gap, but obviously we expect to also see equity markets dropping across the board. We should see some sluggish equity conditions up into probably trading tomorrow. But I think more so over the course of the week, I think we should see the situation normalize. Once again, the thing about the US Treasury market, which most people seem to forget amidst all this hype and hoopla, is that it does remain the most transparent, most liquid, and one of the deepest liquidity pools in the financial markets. Investors will not be fleeing the U.S. Treasury market because of this downgrade. If we look at history, back in May of 1998, Belgium, Italy, and Spain were also downgraded and stripped of their AAA ratings by the rating agencies, and their bond prices barely moved after a week. We look closer to March 2009 when Ireland was stripped of their AAA rating, and then again also their bond prices dropped about 0.18%. So I think the market should normalize and they will move back to the fundamentals about the U.S. growth story and the recovery of the U.S. economy. What we will be watching for is Wednesday's FOMC rate meeting, whereby we hope to get clues about further QE measures. But we expect the euro to remain between that range of 140 to 145. GBP will also remain between 160 and 165. And possibly if there's an announcement of QE3, we could see a bust out of these ranges.
And also the European bond markets are in the spotlight today. The European Central Bank is said to give the Spanish and Italian bond markets a helping hand by buying bonds of the two distressed countries. Spanish and Italian government bond yields fell sharply today, with traders saying the ECB had stepped up its program of bond purchases to now also include debt issued by Italy and Spain. The step became necessary, economists say, to stop the Eurozone region's debt crisis spreading to its larger economies. Meanwhile, the markets are focusing on who will be next to lose its AAA credit rating. Likely candidate, some experts say, is France. However, the country's credit rating remains AAA and the outlook on the rating is stable, a representative of rating agency S&P said in an interview published on Monday. Before we go, here's a quick overview of the oil, precious metals and currency markets. And after that, we have the day's sports news for you.